Hey everyone, Dave here talking to you today about a really cool but really complex and hard to execute tax strategy, which is the STR or short-term rental loophole strategy, and really answering the question, are you a good candidate for this? I'll cover some other things, what can blow this up, etc. But really that's what we're trying to decide here. Um, are you a good candidate for this tax strategy? So outline for today: what's the short-term loophole tax strategy? Who is a great candidate? How much can you realistically write off? And then what are the big landmines that blow this up? So first of all, STR, starting really basic, stands for short-term rental. And at its highest level, this strategy allows you to write off significant income versus losses generated during the renovation and startup phase of a large short-term rental property. Specifically, the mechanics of this is you buy a large property that's a good candidate to become a short-term rental. You do major renovations on it. You write off a big chunk of these renovations via bonus depreciation paired with a cost segregation study. You put the property into service, and then you or your spouse can meet the material participation standard, which enables big one-year losses to offset ordinary income. So we'll talk about some of this in more detail. But who's a good candidate? Well, this is often somebody who's a W-2 employee. Maybe both people in the couple are W-2 employees. Typically a big surge in income. Maybe it's due to significant equity compensation. And, doing this for like a bump of 25,000 in income probably isn't worth it unless you really want to get into managing short-term rentals anyway, and then it almost doesn't matter. But this is on the scale of like 100,000, 150,000, a big surge in income that you're trying to prevent taxation on, or write off that income on. And so that's the first piece. You've got that extra income. The second is that and this second bullet, like there's so much in here, and I'll talk about some of this in the section on what can blow these things up. But you or your spouse has the time and ability to research a good market for a short-term rental, identify and buy a good property, hire contractors, manage the rehab, do a proper cost segregation study, and put the property into service, all on the timeline that's needed. And so, again, so much of that is fraught with having things go wrong, and we'll cover that in detail later. Then not only do you have to do this on the front end in year one, but then you have to run it, and you have to run it as a short-term rental, and either your average guest stays have to be 7 days or less, or you can have stays up to 30 days or less, plus provide significant personal services in the form of cleaning, concierge services, etc. And then finally, your spouse has the time going forward to materially participate. And we'll get into what the definition of that is. According to the IRS, this is an audit trigger. And so these things often do get audited because it's just such a huge write-off potentially. And so you have to keep accurate records. So what is material participation? The IRS requires real documented participation that fits into at least one of the following. You either do 100 plus hours in the year, and nobody does more than that. You do 500 plus hours, which is a lot for a single property, but some people get there. And then a final one is you pretty much do everything, whether it's you or your spouse or the combination of the two of you. If everything is 90 hours in a year, that will certainly do it as well. This can get blown up though in an audit. Either if you start heavily using a property manager, you get busy with other things, you don't meet the 500 plus hours, or you keep poor records. So let's look at a case study. We're going to rip through a lot of math here. And, this is probably the section that I'm the least comfortable with. I've spoken with clients about these. I have an active client who is currently pursuing one. You really need to talk to a tax professional and a cost segregation expert before proceeding. But we're going to go through some really high level math. Let's assume that you buy a property for $600,000 and you do a $250,000 rehab. we've got, I think, 6 steps here. The first is to chop this up. How much of this can be depreciated in terms of the overall property? Typically that's 80%, or in this case would be about $480,000 total. Then we have to define 5-year property, 15-year property, and then also what you can do for kind of year 1 straight line depreciation. And so 5-year property, again, there's huge ranges on this depending on the building, and you really do need to engage with a cost segregation expert. But let's assume 25% of the building fits into 5-year, 15% of the reno. You total that up, and that's about $157,500. We'll determine how much 15-year property. It's about 5% of each, and that total is $36,500. And so we sum up the total that's eligible for 100% bonus depreciation, and that total ends up being $194,000. Then to get to how much we can write off year 1 with normal depreciation, we have to calculate the depreciable basis. That clocks in at $536,000. Here's the math. Calculate the first year depreciation. We take that depreciable basis and divide it by 27.5. That's $19,491. We roll it all together. That big bonus depreciation number of $194,000 plus about 20 on the first year depreciation gets us to about $213,500. And again, this is a lot of work. You need a lot of skill, but there's very little in the tax code that can allow you to write off that much income in a single year as a W-2 employee. Now, big landmines that can blow this up. So the first is you buy a bad property. This is a very kind of cool and exotic tax loophole that we're trying to take advantage of. But if you buy a bad property, it doesn't cash flow, and you're stuck with this thing. Bad investments are still bad investments, even if you get a tax break on the front end. Second is grossly underestimating rehab costs. I've done this. It happens. You need to hire the right contractor, somebody who's done this exact kind of work. You can talk to their customers. They've got great reviews online, and we don't end up having a bunch of change orders and cost overruns along the way. The third is you miss the timing. There's a lot to do here. We have to go research a market, find a property, hire a realtor, hire contractors, define the work, do the work, get this thing put into service and available to rent. And squeezing that all into a single tax year, again, with how difficult it can be at times to find skilled contractors to do this stuff and do it promptly and well, you can end up running past your deadline and missing this big income surge. A fourth that's kind of out of your control, short-term rental markets or the regulations change in a municipality. This threat is real. It happens. Or the local market just simply becomes oversaturated. You have to be cognizant of that. And then finally, the transaction is disallowed because you don't meet material participation criteria, either because you just don't make the numbers, you start using somebody else for property management, or you just keep bad records. These things do get audited all the time because, again, you're writing off so much income in some of these cases. And so you need to be ready for that from an audit standpoint. So the bottom line is, this is not for the faint of heart. Proceed with caution if you are considering embarking on this. Tap into and hire the right professionals in terms of tax attorney or tax accountants, financial advisors, cost segregation experts to help you make this happen. And if you do, you'll be really happy with the end result. So that is it. Like and follow if you'd like to see more from me. Take care.